Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
I think I went through all this, but he has many different newsletters. He has an options one, forex and futures, emerging market, and currency ETFs, and he also does manage currency accounts. So at this point, please, I'd urge you to type a question in. I'll relay the questions to Jack, and I want to thank all of you for joining us today. All right, Jack, so let's take some questions. I see a question here. How do people save when they're losing their jobs? It's counterintuitive, isn't it, Jack, that now that the economy is much weaker, the U.S. citizens are saving more. How can this be?
One, whenever there's fear, you tend to save more. Fear about your job, you tend to put money away. Number two, those that can save are saving a lot more because their wealth has been destroyed in a big way in terms of their housing wealth and the stock market wealth, given the big hit in the stock market. So those are the reasons. The reality is savings going up very fast, whether or not the job market's in trouble. In fact, the fear of not having a job in the future forces savings.
So people don't go on vacation. They don't buy that very, very expensive car. They fix their other car. They don't buy houses. All that kind of thing, Jack.
Yeah, all the stuff we're doing.
And that's why the government created one of those, cash for clunkers thing, right? Nobody was buying any cars. They had to do something. Whether that was a good idea, we could leave that to a different day.
Right, that's great. Using U.S. tax money to buy Japanese cars is a great idea.
Well, we used to buy, GM used to have a 70 share. Now it's a 25 share.
Yeah.
Ouch. Yeah. Question from Larry. In your opinion, if we lost our, of course, regarding the U.S., if we lost our currency reserve status, what would the U.S. government do about that problem?
There's nothing they can do. I mean, it'll be a market-based move, and it would happen because of the fact that the U.S. government has been so out of control, irresponsible with debt and preserving that status. Some people have, machinations that the U.S. pressures people behind the scenes, and that may be in terms of pricing oil and things like that, given the U.S. defense shield that they hold over, a lot of people. So some of those things will go on if it's in jeopardy, but once it's gone, it's gone. It's a market-based move, moving away from what they consider once a rock-solid safe haven onto something else that looks a lot better and deeper. We could see, we saw this in the beginning of the century when the British pound was the reserve currency of the world. There were other currencies, around the edges that played cross-border trade roles, so you could still have that, which China is trying to do, and the U.S. still be the main, reserve currency, just lose some of the percentages. And the reality is maybe the U.S. wouldn't see that as a bad thing because in order to, generate enough lubrication for asset markets around the world, U.S. dollar-based credit plays that role, given that we're 70% of reserves. So that process of this U.S. savings, as I was showing you, the change in the external investment patterns, U.S. dollar-based credit is receding in the world, and that in and of itself may reduce the U.S. percentage as reserve status, and that's not necessarily a bad thing for the currency. So please keep in mind, it just because the status starts to change isn't necessarily a bad thing for the country or the currency. It just depends on how it goes about changing, whether it's a crisis or it's a change and a decline in U.S.-based credit receding back into the U.S. economy.
Good point. Mary, I think actually must have listened to some of your webinars because she's talking about, yes, our debt is bad, but currencies compete against each other, though. please compare our situation to the euro and other currencies. Which ones look like they would appreciate against the United States dollar, and which countries are in worse shape than the U.S. dollar?
Yeah, it's really a great point Mary makes, and I try and make this that it's all a relative game. We hear all the bad news in the U.S. because we're closest to it, but from a demographic standpoint, and this goes to I think another Mary's point earlier about the U.S. a permanent collapse in the U.S. economy. If you believe that demographics are destiny, the U.S. is really as well placed or better placed than any of the industrialized economies in the world. Europe has huge pension liabilities at the moment that are just building up, and their demographics are very, 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 very bad. They're about to turn the lights out there in the next 20 years, where the U.S. is replacing itself. So from that standpoint, the relative debt buildup over the next several years in Europe, because of these pension liabilities, and a lot to do with the inflexibility of labor still throughout Europe, and if you add in the private sector debt in the banking system in the Eurozone, which far exceeds anything in the U.S., you've got to look at the Eurozone economy and say there's a real potential whopper of the problem there, even though everybody's focused on the U.S. Debt system. So it's a great point.
People love to attack the U.S. I guess it's just easy to do. Sure. Andrew has a question. He says, is the administration holding up its end of the reserve currency bargain? For example, how can $1 trillion deficits be squared with these responsibilities?
I don't think they can, and I think that's part of the concern. When they're, Steve, you heard me say this last time we talked, there was something called the Washington Consensus, which is alive and well in both parties for many, many years, in which the idea was ultimately we're going to rebalance this global economy and rein in U.S. spending. But the credit crunch proved so nasty. At the last G20 meeting, they basically abandoned that and decided that because of the real change in the demand patterns, that the major economies and the U.S. leading the charge was going to stimulate the global economy instead of just letting the market let this stuff play out, because ultimately you need to deleverage, but they're doing exactly the opposite. So that concern is real, and I don't think you can you can get around that any way. The only thing you can say is ultimately we hope the market wins here, and the U.S. savings rate increases to a degree that increases the ability for the U.S. to draw on a rising pool of private savings.
Yeah, that makes a lot of sense, Jack. I know that, as the other attendee pointed out, it seems counterintuitive, but if we save more, then there'll be more capital, so it just makes sense. But it's painful because even today, yesterday, Lowe's earnings were bad, and we all watch TV, or a lot of us do, and we're long these stocks like Home Depot, and we're hoping that the consumer is spending more, but quite frankly, it's probably bad in the long run if the consumer keeps spending more money that they don't really have.
Yeah, I mean, ultimately, when we were in the perfect storm of credit. We had all that money being recycled in from China. We had all that money being created through the derivatives, and I don't think we're going to see that storm again that pumped up our asset markets and falsely pumped up what we thought was wealth in our 401ks and our houses. Now we're realizing there wasn't real wealth there. Ultimately, real wealth comes from what our parents have been telling us all along, saving your money and not building up that credit card. That's where wealth comes from.
Good point.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.